This strategy starts by developing an understanding of what's happening across the globe. Now, we do this because the driving force behind the financial markets is growth across economies. And any economy, in its simplest form, is made up of businesses and consumers. So if an economy is to grow, consumers need to be spending in order for businesses to generate revenue. And if consumer confidence increases, it's pretty typical to see an increase in consumer spending, which results in increased business revenues. So if a business is making more money than it did last year, all else remaining the same, which way do you think share price is going to go? Now, in order for us to measure growth rates across economies, we'll look at real GDP, or real gross domestic product. And to actually determine if world GDP is growing, we need to look at the largest contributors in the respective leading economic indicators. So the United States, Europe, and China accumulate to more than 50% of world GDP, so these are the economies that we focus on. And if we believe that there's growth across these economies, then we can have a bullish worldview. Likewise, if we believe that there's contraction in GDP, in other words, there's a recession across these economies, then we can have a bearish worldview. So if we're bullish, we believe cyclical sectors will outperform the market, and if we're bearish, defensive sectors should outperform. Cyclical sectors are made up of stocks whose earnings are sensitive to the ups and downs of an economy. So an example of this will be a company that sells high-end retail fashion items. Whenever an economy is growing and consumers are spending, people will be happy to pay for expensive luxury items, and this company would see a rise in revenues. However, if the economy is in a recession and people are a bit more cautious with their money, then the same company is likely to see a drop in its revenues. A defensive sector, however, like a utility company, is a share that you'd find within the defensive sector. This is likely to see its revenues be fairly consistent year to year, regardless of whether an economy is growing or slowing. So, people are always going to be prioritising paying for gas, for electric, for water, before luxury and retail items. Now, there's 5 cyclical sectors and 5 defensive sectors in line with the GIC scheme. This is a scheme that simply standardises classification of shares within industries and industries within sectors. So with our bullish or bearish worldview, we know what shares to look for within a specific industry or a specific sector. And at TradingFM, we also actually look at the earnings growth rate of each industry and sector, and this basically helps us determine what sectors we like best. Additionally, knowing the supply chain of an industry is also great for idea generation at this stage. When deciding what shares to trade, picking the best stocks comes down to good old-fashioned peer analysis. So we'll look at earnings potentials of a company, its forecasted earning estimates, and whether or not a stock has beat its previously quarter estimates. We'll also look at the company financials. It's pretty essential to consider. We'll compare free cash flows and look at the company's financial structure, so debts and assets. Now, timing as well is really everything. We need to look at each pricing chart to ensure that the price trend and momentum is in the same direction as our actual trade. And this whole process basically gives us a nice short list of the best and the worst companies within each sector, so we know what we're going to trade. Finally, we need to manage how we're going to structure and execute our trading ideas. Hands down, the best part about this approach is that we trade in a way that allows us to remove the need to worry about a financial market crash. We remove as much market risk from each trading idea as possible by spread trading and beta hedging our positions. What this means is that we go long or buy one stock while simultaneously going short or selling another stock, and we consider beta when determining a position size. Now, in order to know what stock to go long or short, we have to choose a theme to structure our trades. So we create a theme for our spread trading ideas by deciding if we want to look at sector industry constituents, cross-industry constituents, or cross-sector constituents. Basically, going long or short stocks in the same or different industries. This allows us basically to reduce our risk and not be exposed to the impact of a market crash. We're trading the performance of one company against another. So to summarise everything that we've just covered, we need to be getting perspective on world GDP in order to have a bullish or a bearish outlook. Choose what market sectors and industries that are likely to outperform the market, so cyclical or defensive sectors, and then picking the best and worst stocks in a preferred industry. We then decide upon a portfolio theme for our trading ideas, and then we simultaneously buy and sell the best and worst stocks while hedging out market risk.